Okay, so my last part that I wanted to cover was about protecting your personal income, and I'm going to straddle across both our kind of income protection and ACC, in particular the ACC, to help you understand this. So typically when we look at the books of most small businesses, what we learn when we look at remuneration is that the business owner will largely, in many cases, and more so now lately probably than ever because of the option to ACC Cover Plus Extra, will earn their income by the surplus being allocated out as a shareholder's remuneration. And in many businesses in New Zealand, like this one, the spouse will hold a share, your life partner, your spouse, will hold a share in the company and will have maybe a small role to play so that they can be allocated a shareholder's salary as well. Even though all of the income or the revenue of the business is being generated, say in this case, by Gary. Now, that's great and it works really well in terms of keeping the income tax liability at a lower level. Where it can be risky, or it can create a risk if you haven't got a strategy in place to deal with it, is if Gary becomes disabled as an electrician and can't work and all the business revenue dries up, and in this case, 40,000 of the revenue is allocated to Gary and 32,000 or 42,000, whatever the split is, 50,000 to Gary, 32 to his wife, it doesn't matter. When we go to ACC, unless we have put a strategy in place around ACC, then what the household will receive is 80% of 50,000, 80% gross of 50,000. So the net will be getting down into the 30,000 amount, despite the fact that the household actually was receiving 82, because IRD, in its standard cover plus product, will not look at the fact that that income has actually been split between two parties and that the real loss actually sits with Gary. So this is a problem for a lot of business owners where the strategy for how your income is being received is helping you reduce what you pay in personal income tax, but to do that it's actually reducing the personal taxable earnings that you declare. Now, it can also be a serious problem on income protection if your advisor who's working with you doesn't understand the types of products out there and doesn't understand how your income is being allocated to you from the business and takes your word that it's a $80,000 surplus and sets up your income protection policy based on that, so the intention would be you'd get 75% of that loss, but when you go to apply for the claim, the insurance company says, oh, but hold on, your taxable earnings are only this much. Now, sometimes we can negotiate after the fact, and get them around, but we never want to have our customers in that position. Right? We want to do the right thing by the analysis up front and make sure that we've identified the loss that would actually occur and we've maximised the protection of that loss by how we've structured things with you at the outset. So one of the big, other things for small business owners, embedded, if you like, in the expenses are things like home office expenses. I have a home office. It allows me to offset 16% of all of my home costs of my house, my mortgage, my rates, my insurance, my power, 50% of my telephone. It's not cash I directly get and I pay tax on it, but it's a financial benefit that I get from the business. Again, ACC won't look at these things. And unless we negotiate these things, depreciation, it's a non-cash item, we can actually get it added back into the total pool of income that a business owner earns if through working through the financials we can identify it, and then we sit down and we negotiate with the underwriter about the real income that is being received into this household, the home office expenses, the depreciation that we can add back in, the vehicle expenses, all of those things, so that where Gary on the surface of it is making a surplus of 82,000, by the time we added all the add backs in, we're getting his income up to 95, 96,000. So if he suffers an event, we're using a much higher baseline for which the calculation is done. But you have to know what you're doing to do these things, and you have to be committed to working with the customers with financial statements to ensure that we get the right information.